Brilliant. So I think we're live, and I think we've already got a question from Peter Dean. So let me just start off with some introductory remarks. Okay, so we are launching a course. So it's called Investment Navigation Through a Crisis, and the purpose of the course is not for professional investors. This is for anybody. You don't need any kind of special expertise in order to do the course. It addresses a lot of the questions that we get asked on a regular basis through the pension craft community. So that's how I know the questions are relevant. And I've used some of the content from the videos which I've been doing, kind of drawn it together, but also made it more structured because it's easy to forget what's already been done. I mean, even I forget, right, what I've already done. So it's all in one place. There's a couple of spreadsheets in there to do with valuation, which are quite useful. So that's now available to buy. And if you go to the description of the video, you'll see a link to the purchasing page. There's a 25% discount if you're a Patreon supporter. So there's also a link to Patreon. So if you join us on Patreon, you get to do the course for a 25% discount. So it's probably worth it. And then if you don't like the community, hey, you don't have to stay. But most people we find tend to stay for a long period of time. So we've got a comment. Somebody says they've just downloaded the course. That's Ivor Sexton, and the course is good. So that's great. Thank you, Ivor. I wonder if there's anyone else on here who's already done it. So Nuno Taborda says, random question. I recall one of your videos you mentioned you had a background in physics. How did you switch to economics? Well, long story, but I worked for an investment bank for, well, two investment banks actually, for about 15, 16, 17 years, something like that. So originally I started off working on risk systems because I was numerate. And then I switched to working on risk systems at another bank. And then I switched to education. So I did financial education at that bank. And then I did, then I wrote my book about investment for professional investors called The Financial Bestiary. And I became a strategist, which means you write research, and that's for professional money managers. So you swap ideas with professional money managers and give them ideas about asset allocation. So that was my background. So that's how I switched, but I still love physics. So I still spend quite a lot of time tutoring physics and maths with kids, which I absolutely love. Other questions? Jay Hoos says that the course is excellent. I guess you're talking about the course. Thank you very much. Thank you. Do you think the market's already bottomed? If not, when do you think this will happen? Thanks. Okay, so I mean, personally, I can only tell you what I think, right? So I think the size of the layoffs that we've seen in the United States are just astonishing. If you look at the initial claims, it was 6.8 million last week. It's 6.6 million this week. So I think that's completely unprecedented. So it's really hard to say how big the economic impact is going to be. But I think expecting everything to snap back to exactly the way it was over the space of a few quarters, which is what some of the earnings forecasts are telling us, personally, I think that's unrealistic. So I think it could take some time to undo the damage that this is going to cause. So I strongly recommend you have a look at what Jay Powell said on Thursday. I just love the guy. He's so statesman-like, you know. He sounded quite presidential when he was talking. But he was talking about all of the measures they've done in order to counteract the liquidity problems, the problems for people on Main Street, not being able to get enough money together to live. So they're really pulling out all the stops with their financial bazooka. And they've certainly been very preemptive with their actions this time round, which is great. Markets loved it. We're still not back to where we were, but I think it's probably going to get worse. I think the Fed can only do so much. It can't stop defaults. So I think if we do get some kind of credit events leading off the back of this revenue problem, which is effectively what we have now, then that could be self-perpetuating. And the Fed can make it not so bad, but it can't bail out every company and every person. So I think ultimately, I think it is going to get worse before it gets better. But hey, I don't know. I don't make forecasts. All I do is provide financial education. So, which risk systems, credit or market? Well, I started off in market risk. So I created this non-normal copula simulator, which which did Monte Carlo simulation to work out, the tail risks that were present in the bank's positions. And then I moved on to credit risk later on at the next bank I worked at, whose name I won't mention. Thanks for your live. I've started investing this year and I'm grateful for your invaluable content. My question is, this is Makrini Mehdi. My question is, I'd like to become a financial advisor, starting doing the diploma. That's great. Regulated financial planning. Is there anything else you'd recommend? Not really. I mean, certainly read around the subject. Don't limit it to the stuff that you do on the course. Because even if you do something like a CFA, I've found that's fairly restrictive in terms of the stuff it covers. I mean, I worked in investment banks for a long time before I realized the SPIVA report and what that was telling us about underperformance of active managers. So, you can be working in the industry, but you kind of miss the big picture, if you know what I mean. Now, I've been told to say, because I'm a newbie to YouTube Live, you have to like and share the stream. If you do like and share it, that is. So please do, because apparently that flags it for other people. So I'd appreciate it if you could just like the stream and share it if possible. That would be great. As well as YouTube, do you have any other ways of earning money? Side hustles? Thanks for the live stream. Yes, I teach physics and maths. So if you want to do any physics and maths tuition, I'm happy to help. But my primary business is now PensionCraft. So hopefully we'll make PensionCraft pay enough so that I can not teach physics and maths so much, or not at all. But we're still not quite there yet. But the Patreon supporters have been great. They've certainly been stepping up and supporting us, which I really appreciate. Because for us, it means that we don't have to worry about not being able to pay the rent, which is very hard to make videos if you're homeless. As a UK-based investor, is there any advantage to being home biased? Could you explain why the Vanguard Life Strategy funds are UK heavy? Well, yes, interesting story. I wrote to them. I wrote to their support people, who are usually great, and they were in this case. And what they said was that it's easier to market the life strategy funds if they have a domestic bias. And the domestic bias is huge. I think it has a 25%-ish allocation to the UK for the 100% equity fund, Life Strategy 100. And the UK MSCI global weight is something like 5%. So that's a 5-fold overweighting. They said it was triple overweighting, but I think it's more like 5. Depends on the index you compare it with. But obviously, home bias is usually a bad thing, something that you should avoid, because it is a concentration risk. Unless you're absolutely convinced that your home country will outperform. Any other questions on that theme? I guess the only kind of benefit might be that you're familiar with your own index. I think that's why people like it, because if you look at a newspaper in the UK, usually they'll talk about the FTSE 100, whereas if you look at the S&P 500, it doesn't feel like it's about you. But I think that's kind of like a very small benefit. It's much better to be globally diversified. Um, uh, Taimur Khan says, I'm a legend. Oh gosh, thank you very much, Taimur. Um, what are you thinking about all the money coming from the Fed in relation? Oh dear. What do you think about all the money coming from the Fed? Oh dear, gosh, there's lots of stuff now. Yeah, what do you think about all the money coming from the Fed in relation to your view on the potential credit crisis? Will it help avoiding it? This is Mr. Whiteadder. Yes, I think it will soften the blow. Now, they've also announced that they're going to primarily buy exchange traded funds and investment grade credit. This is their secondary market liquidity facility they're talking about. But they will also now start buying high yield or junk bond ETFs. So if you look at some of the large ones like HYG from iShares or JNK, you'll see they've rallied hugely on the back of that news because the Fed's going to be buying junk ETFs. But I think they can only do so much. We've had something like 10 or 11 years without a big shakeout in credit. And there are lots of zombie companies out there which literally are rolling over their debt and issuing new debt to pay off their previous debt. This is exactly what Minsky would have called a Ponzi unit. So I think for those companies, in particular sectors like the restaurant sector, like any kind of client-facing sector, or the energy sector in particular, because of what's happened to the price of oil, how do you prop up a company where it's just not financially viable? I think you really can't. So I think there will be a higher default rate. It's just a question of how bad it's going to get and whether it'll be a global phenomenon. But certainly the Fed is kind of softening the blow. They've done an amazing job of being preemptive, which I think is great. Do listen to Chairman Powell. He was great. It's the Brookings Institute YouTube channel. That's where he was on. It wasn't the usual Fed channel, which is why I couldn't find it. So it's the Brookings Institute Fed channel, YouTube channel. Okay, I'm going to scroll down. Lump sum today or pound cost average into stocks over the next week's month. This is Mark Westaway. Yeah, I mean, it's almost impossible to call the bottom of the market. So, I mean, what you can do is look at valuation. But what generally happens during one of these big crises, it happened in 2001, it happened in 2007 and 8, is during these big sell-offs, you get huge rallies, 20% or more, which is exactly what we've seen. But those often reverse, right? So remember that we're only about 2 months into this, and that would be an extremely short crisis if it is true, if this is the end of it. So I think it would be very unusual if it stops after 2 months, given that the ongoing cause hasn't gone away, and it probably won't go away until there's some kind of cure in the form of a vaccine. So I think this is going to go on for some period of time, but I think the Fed can only do so much, I think the Fed can only do so much until there is an effective way to stop the infection, which would be a vaccine, which will take probably over a year. So that's why I think lump sum investing at the moment is probably quite risky. If you do dollar cost average, then you don't have to call the bottom. And we are cheaper than we were, 2 months ago. There has been a big rally, but if you are going to drip feed into your portfolio, then you can make use of those periods when it falls, because that'll buy you more of the risky assets. And then when markets rally, then obviously you buy less automatically because of the dollar cost averaging effect. So that's why drip feeding is great in periods of high volatility when markets are whipsawing up and down. Because otherwise, if you are going to lump sum, you get nervous about how to time it, which is an unhealthy psychological thing when it comes to investing. It's best to be exposed to the market as long as possible. So drip feeding is usually the way to make people overcome their fear of investing, I've found. You may not time it perfectly, but it usually does quite well. What kind of paradigms do you expect to emerge after the pandemic? I think certain aspects of behavior will remain different for a while. So, for example, after 9/11, it took people a long time until they started flying as frequently as they did the before 9/11. So I think this could be similar in the sense that we're all kind of more aware of the risks now. Whereas before you'd never really thought about it, right? When you fly, you never worried about it. You didn't wash your hands the first thing you did when you came home. So I think people's behavior will change, but probably for the better because, there are other infections that are equally nasty, but, we'll probably be more aware of these things now. I think there'll probably be some kind of legislation post hoc. They always try and fix the previous crisis. So perhaps there'll be some new legislation to ensure that this kind of thing is less likely to happen again. But certainly in terms of the financial robustness at the moment, it's pretty good. The stress test that banks have been doing maybe will be a little bit short of what we're seeing right now. So I think we weren't prepared for this kind of crisis in particular, a very sharp and very deep crisis. What we were expecting was maybe a 20% reduction in growth at most. But what we could see is a very rapid increase up to that level and then perhaps a quick exit as well. So I think the stress tests will probably change to reflect this crisis. But the good thing is that banks are well capitalized, so they can probably carry on lending through this crisis, which they weren't in 2008. Any thoughts on investment trusts as a preferred vehicle for income investing due to the advantage of their revenue reserves? Yeah, I mean, that's one of the benefits, I think, of this is Nick Barnes. Thank you, Nick. What I would say is that, for illiquid assets, income investment trusts are great because they're closed capital. So there's none of this nonsense about having to gate a fund. So you don't have to gate it because you don't have to sell the assets. If people are selling your fund, all that happens is that the price to NAV falls, the price to net asset value falls. So they're not forced sellers of their assets, which an open-ended fund like an ETF would be. So we've seen several UK property funds gated. I think it happened to Aviva this week and it happened to M&G a few weeks ago. And those funds remain gated because people were selling the fund. The assets were illiquid, so they couldn't sell them. So they had to gate the funds. And we're also probably going to see peer-to-peer lenders go through a similar situation because their assets are very illiquid, which means that they'll have to stop people pulling their money out because they just won't be able to sell these very liquid loans quickly enough. So I know that some of the peer-to-peer lenders have also frozen redemptions in the UK, possibly in America as well. I'm not aware. So if you do know of US ones which have frozen redemptions, do put it into the chat. I'd be interested to know. So yeah, investment trusts, great way to buy illiquid things. Slightly concerned for some of them because some investment trusts are leveraged. So potentially that could be a problem in this kind of environment. You want to keep away from things which are illiquid and leveraged. So I'd be concerned about those two factors. But of course, not all investment trusts are levered. What factors do you think will drive the stock market in the future? This is James Spur. Some companies already are leaders in their field, such as Amazon. So can they continue to perform? I think certain companies will not be affected by this. That's pretty clear. Airline companies will. Anything to do with face-to-face contact with clients, hairdressers, anyone who sells cosmetics, all of these companies will be affected, but things which won't be affected would be something like grocery stores, which have obviously carried on doing their business through this, doing good business through this crisis. So I think for certain companies, like tech companies, obviously companies like Zoom have been doing great. But yeah, I think it really depends on the sector. But tech companies obviously are least affected because staying at home, you can still use tech. So the tech story will, if anything, be strengthened as a result of this crisis. Cuban C asks, do you have any input about Romania's stock market and also real estate in the next 6 to 24 months? Thank you for the value. Romania, I have absolutely no idea about the Romanian stock market. I'm sorry. I mean, house prices, yes, generally. They have very strong linkage to GDP in the country in which they're based. So if this has a negative effect on GDP, then obviously it's going to have a problem, create a problem for the housing market.
Super chat.
Oh yes, we've got a super chat, and can I find it?
Can read it too.
Yeah, go on.
Do target date funds use drip feeding or DCA like Vanguard Target Retirement 2065 Fund VL?
Oh yes, I've got it. Target date funds use drip feeding or DCA like Vanguard Target Retirement 2065. Thanks for the financial education. It's been very helpful. Chris Brown. Okay. They don't use drip feeding. I mean, it's just like any other fund, a target date fund. It has a fixed allocation, which very gradually de-risks over time as you approach your retirement date. So usually it buys a list of funds which are provided by that company. So if, in the case of Vanguard, it just buys a set of Vanguard funds. In fact, I can probably show it to you here if I can find how to do it. So I can share my screen. Let me just do that. So here we go. So I should be in the bottom corner, hopefully. So here's Vanguard. And if we go to the top, we should be able to find Vanguard funds, what we offer. Here we go, target retirement. And let's just take any of these, it doesn't really matter. So 2065, let's say. So what you can see is that it just owns a whole bunch of Vanguard funds. And obviously over time, it'll reduce the equity allocation and increase the fixed income allocation. But it doesn't drip feed in that sense. You just buy the fund and you get a slice of this portfolio. So you can drip feed into the fund, but that's up to you. So to answer your question, no, it doesn't drip feed. It has a glide path which reduces the risk over time. So that's the way target retirement funds work. I hope that answered your question. Okay, and back to this. Right. What factors could trigger inflation? Yeah, so what factors could trigger inflation? Well, I mean, typically it's an increase in, I mean, there are various ways you can get inflation spiking. In this particular case, it's going to be a supply shock. So if there's not enough supply of goods and services, which is because supply chains are being disrupted, then that can push up prices. It's unlikely to be due to demand pull, because people aren't suddenly becoming richer and then demanding more goods and services which companies can't provide quickly enough. That's not what we're seeing in this kind of environment. But then you've got the countervailing force at the moment, which is a lack of demand. Because if we're staying at home, you know, we're not going out and eating out. We're not spending on holidays, clothes as much as we would normally. So I think the problem at the moment is a demand shock, which is disinflationary. And depending on which country you're in, you know, either the disinflationary effect of the demand shock will win or the supply shock will win. It really depends on the timing of those two factors. There's a really nice paper on this from the National Institute for Economic and Social Research, NISA, which I talked about last week on the live stream. It's definitely worth a look. Very good paper. Right. Oh yes, I should say again. Please like and share this stream, because that way other people will know it's happening, and basically it'll send good karma for this channel. Have your expectations about the S&P 500 valuations changed after the latest Fed interventions? That's Byrne, brilliant supporter. Do you still expect the S&P 500 reaching the 2,000 points or even lower after the Fed intervention? I mean, as I say, I think the equity is not looking cheap, and the reason why I'd buy equity would be that it would be cheap. So at the moment, I still don't think we're pricing in much of an earnings fall. So if you go to FactSet, which is the earnings provider, they provide information about earnings on the S&P 500. What they've shown is that the earnings downgrade so far, it only expects a 10% fall in earnings for Q1 2020. Now, obviously this is just the beginning of the effects of the pandemic, but I think that's possibly a little bit optimistic. I think it could get much worse than that. And I think valuation does matter, even if the Fed's printing. So personally, I think we could see values. I think we could see prices fall much further because the fundamental support for prices is much weaker if earnings do get downgraded. What I'm really waiting for is to know what the earnings are. So that's why I'm going to hold off until we get more data on earnings, but also on the economics of what is going on. Because really we're flying blind at the moment. So I really do want to see what's going on. So we've got another question. As a Canadian, I can't own IRES 0QT8, but it's a cap REIT spin-off, a great Canadian REIT. They also have EREUN. Please check these out if you can. I don't think I can actually, but I can Google it. I'm not familiar with them. Perhaps you could tell me in the comments if they are these funds. So is it European Residential REIT? I think that's the one you're talking about. In which case I've got it here on Morningstar. Let me just share my screen so you can see this. Okay, so this is the European Residential REIT, and so let's have a look at the geographic analysis. I wonder if it's okay. So it's European Real Estate Investment Trust. It's open-ended. So firstly, it's holding very illiquid assets, which is real estate. It's the first Canadian but European focused multi-residential real estate investment trust. So I guess this is buying blocks of flats. So multi-residential, I guess, means, you know, apartment complexes in the Netherlands. Yeah, so I think the danger with these illiquid assets is that when there's an economic slowdown, real estate gets hit very, very hard. So depending on how long this crisis lasts and how bad the economic damage is, you can start to get a problem with rent. So people can't afford to pay rent because if they've been laid off, they can't afford to pay rent. And that feeds through to the real estate investment trust, whose income starts to fall. And then the income paid by the REIT starts to fall as well. So certainly if you look at global REITs, they're probably the hardest hit asset class of all the ones I looked at over the last few weeks. So I would be concerned about real estate investment trusts because they're illiquid and they're highly exposed to economic growth. So I would be concerned about that. Real estate investment trusts anywhere, actually, because I don't think any country is going to be unaffected by this. So back to the comments and back to the live stream. Okay. I'll scroll down to the bottom. What impact will the current crisis have on factors that affect house prices in the UK? Should we expect a decline in prices comparable to 2008? Again, it depends on on the GDP impact, on the economic growth impact. Now, in the UK, one of the very supportive factors is that interest rates are almost zero, which they are almost anywhere. So borrowing is cheap. But if people's earnings are going down, then that means that the amount they'll be lent is a multiple of their income. And if people are less secure in their jobs, if they're more likely to lose their jobs, which they are in a recession, then they'll be less likely to spend on housing and on buying a new house. So firstly, the banks will be less willing to lend in an environment where credit is more shaky, which it is, but also where job security is lower. And the multiples that they give for home loans will probably be smaller. They'll be more cautious about the loans that they give. So, everything is kind of conspiring to make it bad for the housing market, if you like. So that's not a great environment for housing, for the UK or anywhere for that matter. But would it be comparable to 2008? Very difficult to say. Again, it depends on the duration of the crisis and the speed with which we recover after the crisis. It's odd that despite the COVID situation, the S&P had its best week in 46 years. Why is there such a bullish run given how bad the unemployment situation is in the US? Yes, I agree. It's very weird and slightly unpleasant that, we've had over 12 million Americans lose their jobs over the last fortnight, over the last 2 weeks, and yet equity markets are rallying. It's purely because of the Fed's bailout packages. Plus, people are starting to see a fall in the increase in the rate at which cases are being reported. So I think it's a combination of people kind of seeing light at the end of the tunnel in terms of the infection, but also huge stimulus on the part of the Fed. So I think it's a combination of those two factors that made equities rally and risk assets generally. Okay. Unlimited QE. Yep, unlimited QE is very hard to argue with. So the Fed and the ECB and I guess the Bank of England will do absolutely whatever it takes to keep the financial system running, to keep it liquid and to keep faith in the currency. They must, right? That's their remit. So yeah, I think I wouldn't underestimate central bank action. I think it is probably going to at least support things like treasuries. Whether they can support risk assets is another matter. So things like equity and REITs and junk bonds. I think that's less likely because sentiment will probably turn south more than they can bail out those assets. And the Fed isn't talking about buying equities yet. But of course, the Bank of Japan does buy equity ETFs. So who says, you never know. Maybe the Fed will start doing that too. A cruise company's worth a punt. This is Johnny Wurzel. In fact, I spoke to somebody who'd bought Carnival this week. And I think the Saudi Sovereign Wealth Fund has also just bought a big chunk of Carnival. Personally, I think this might be one of those things which I think sentiment may turn against certain leisure activities. Now, being cooped up on a very small ship, well, not particularly small, but on a ship with thousands of other people in fairly close quarters may not be a very popular pastime in the future, given the experience we've just had. And I think people will remember what happened to those ships that just couldn't dock because nobody wanted them. I think that'll remain in people's memory for a long time. And I think it'll be very difficult to market cruise ships once we do see an end to this current crisis. So I think that is a very brave move if you are going to buy those. But obviously, the stocks have come down a lot So they're certainly cheap, but they're cheap for a reason. I mean, I never buy single company stocks, so it's not a concern for me. But some people, some people are willing to take that risk, but I wouldn't. Um, are you watching China or Europe as the first domino to drop to cause financial problems? This is C. Sull. Um, I think certainly China, probably because firstly it's more important systemically, because it's bigger, um, and there are very well documented credit problems in China. So simply the size of the credit market and the amount of leverage, both for companies and for households, was flashed as a risk by several central banks. This is, before we had any crisis at all. So I'm concerned that that's going to be the kind of this may be a trigger for those risks to actually come to fruition. So that's my worry. Obviously, the way the centralized government in China will do everything it can to stop those credit bubbles popping. But this was always a tail risk when I was a strategist, which was a China hard landing. Now, typically China will grow at something like 6%. It was very gradually slowing down, but now we're talking about Chinese growth of 2%, right? So this is the Chinese hard landing that we're going to see over the space of the next few quarters. So again, it really depends on how quickly demand for Chinese products picks up elsewhere once the rest of the world has gone through the crisis after China. Because obviously their domestic demand will pick up faster because they've gone through the crisis more quickly and they went through it first. But now they're going to be affected by a lower demand for their products elsewhere in the world. So it'll be interesting to see what happens with Chinese growth, because that's a key thing to watch, I'd say. So keep your eye on that Chinese PMI, which did bounce back. But remember, the PMI is just relative to the previous time period. So it doesn't necessarily show the size of the fall. It shows you what percentage of them improved, what percentage of company thought conditions would improve. So I'd say China more than Europe, in answer to your question. Okay. What UK ETF do you think is best for income? VUKE, VMID, VUSA, or VWRL? This is from Prince London. Now, dividends, obviously, when you get a recession, what generally happens is that companies cut their dividends. Because if you're worried about surviving a crisis, you don't pay out your cash to your shareholders. You preserve the cash on your balance sheet so that when your revenue falls, you don't go bankrupt. You can still service your debt and pay your employees and your suppliers. So I think what we're already seeing for many banks, for example, in the UK, they've cut their dividend, and we're probably going to see insurance companies do the same thing. And I think that'll mean the UK market, which is very much geared towards dividends, I think that'll make the UK market much less attractive. So if you are an income investor, I'd be very cautious about the quality of the dividends and the kind of sustainability of the dividends for the companies that you buy. And many of the markets would traditionally pay very high dividends, like Australia and the UK, will probably start to cut those dividends. So just be careful about that. I think finding income in an environment like this, again, requires you to take a lot of risk, or being very selective about the companies whose shares you buy. So I'd worry less about income in this environment and more about capital preservation, probably. Torn between Vanguard FTSE All World High Yield and the Vanguard FTSE All World Non-High Yield. Can I have your input? Okay, so just to point out that those are both we're talking about equity funds, right? Because Vanguard in the UK doesn't have a high yield credit fund. You can't buy high yield credit with Vanguard in the UK. What they do have is high income or high dividend equity funds. But yeah, I mean, if you are going to go for income, that's what you'd go for. But as I say, be careful, because in this kind of environment, there's going to be a lot of dividend cuts. You should be more thinking about preservation of capital if you do think it's going to get worse, which I do, you may not, or capital gain if you think we've kind of bottomed out. So that should be your kind of thought processes at the moment. Probably less about dividend, I'd say. Okay, another super chat. I'm thinking to start investing with a very aggressive portfolio, 40 plus years. Oh, I see no grey hair. Marvellous. This is Dion Rosema. What do you think of 60% NASDAQ 100, 25% financials, 10% small cap and 10% in energy and or travel? Well, that certainly is high risk. So what I would say is be very cautious about single stocks. I mean, what you could do is go for sector ETFs and do a sector play, perhaps. If you are going to be investing for 40 years, then yeah, now valuations will be cheaper, certainly cheaper than they were 2 months ago. So for you, hey, you might not catch the bottom, but who cares? Because 40 years from now, no one will even remember this crisis. And, you know, now you'll see probably fairly good entry points, or relatively good entry points. There may be better ones later on, but I'm guessing that you'll probably be drip feeding into your portfolio, Dion. I'm not sure if that's true, but I'm guessing that's true for you, because when we start out, generally we don't have a large capital amount to invest. So, you know, early on you're probably drip feeding, in which case you'll dollar cost average anyway. But just be aware that you are taking a lot of risk with that portfolio. So whatever you do, buy, don't sell in this market. This is a buyer's market, not a seller's market. Okay. Particularly if you're a long-term investor as you are. So if you're young, great. Well done. You've got the best asset of all, which is time. Johnny Chivers. Do the Vanguard Life Strategy Fund prices reflect changes in the underlying assets straight away? Wondering how long earnings will take to reflect. Okay, so the Vanguard Life Strategy Funds just buy Vanguard equity and bond funds. So as soon as equity prices price in lower earnings, that'll be reflected in the fund prices. But at the moment, what we're seeing them reflecting is Fed bailout, right? So the Fed stimulus packages are what drives markets at the moment. In fixed income, even in countries in emerging markets, right? Those are being driven by the Fed. Everything is being driven by the Fed right now. So the Vanguard Life Strategy funds are also being driven by the Fed, and less about earnings. But over time, what we generally see is that equity markets are rational, but it just takes a while for them to value things properly. And we will see prices fall into line with earnings. That's certainly true over the long term. It's always happened in the past, and it probably will happen always into the future. So normally that takes a while, right? So there'll be a Fed stimulus, you get a rally, and then some bad news comes along and you realize that, you know, lockdown will last longer, and then it goes down again. And then there's a promising drugs trial, and then equities rally. And then, you know, there's a constant whipsawing of good and bad news in this kind of crisis. And there'll be more packages from the Fed, more packages from fiscal packages from the governments in order to help their own economies. So, you know, things will be whipsawing around for a while, but ultimately, if earnings fall, that's going to be factored into prices. It could take months. So the earnings seasons happen every quarter. So this latest earnings season, which is just about kicking off now, it should kind of peak in about a week's time, or we should get several companies reporting in about a week's time. That's for the earnings for Q1 this year. So bear in mind that won't factor in the full effect of the lockdown globally. So we're going to need at least 2 earnings seasons, which is 6 months, before we really see the effect on earnings. So it could take some time. Okay, just be aware of that. I think there was another super chat which I have missed. Okay. No, I didn't miss it. Okay. Do you think poor earnings are already priced in? No, because we haven't seen the poor earnings. Earnings haven't been updated yet. We've only seen Q4 2020, which was kind of okay, right? That was before it hit. So we're still about to see what happened in Q1 this year. And we won't see Q2, which is like now, until 3 months after that. So that's why I'm saying I'm probably going to hold off for a while before I commit a large amount of money to equity, because it's hard to know what the value of stocks is if you don't know what earnings are. Is it best to keep current Vanguard Life strategy weighting chained to a safer one, or invest in a new one to take advantage of lower prices? This is Rob Murphy. Well, what I would say is, when I speak to the pension crafters that I spoke to before this crisis, we had this discussion about what would happen in a crisis, right? And we set the allocation for equity such that a 50% fall wouldn't make them sell. And we said, look, there's going to be a 50% fall in equity at some point in the next decade, probably. That wouldn't make you sell with your current equity allocation, would it? And so that's how we decided on, or at least that's the thought process we went through when they were kind of discussing their equity allocation. So yeah, I'd say probably it's best to have a plan before these things happen. But what I would say is don't sell if you have equity. So I've still got 20% equity in my portfolio, and I'm not going to sell it, right? Because equity markets could rally. So that's why we diversify, because we could be wrong. It's only very arrogant people who take hugely concentrated positions because they think, or at least they pretend, that they know what's going to happen. Diversification is just the humble person's admission that they don't know what's going to happen. So they position their portfolio for a variety of outcomes. So I would say find an equity bond split you're happy with and stick to it. That's the simplest thing you can do. So for example, Johnny Shivers is saying quite rightly, my ISA is in Vanguard Life Strategy 100 and the Vanguard S&P 500. I'm thinking I'm overexposed to the US, but I've got 30 to 40 years till retirement and no need to sell. And that's exactly the right kind of attitude. If you've got a long time, you can just ride out the volatility. You don't care. This just means equity is cheaper, right? So this is a good thing for you. It's like a house price crash. For first-time buyers, it's great. For old people like me who've got savings, not so great, okay? But for people who are just starting out, it's a good entry point. How are we doing for time? So let's say another 14 minutes. So yeah, I should say again, like and share. Like and share this stream, because then other people will know about it, and it's generally good for the channel.
Of course.
Oh yes, and I should mention that all of the things we're discussing tonight are on the course that we're launching. You'll find the description of the course in the description of this stream, and you can also get a 25% discount on the course if you're a supporter on Patreon. That's just a way of thanking our Patreon supporters, which effectively keep us off the streets and make sure we can eat. So yeah, please do look at the course. It brings together all of the things which we're discussing tonight, many of them actually, and there's a facts section at the end, frequently asked questions, which cover many of the things we're discussing tonight with links, and it's got some video in there which is exclusive to the course. So definitely give that a look. And I should say also that the course will probably be dynamic. So this is obviously a situation which is changing all the time, and we will change and update the course as things change, because obviously this crisis is evolving as we speak. Right. Is it a good idea to invest in safe sectors such as health, consumer goods, etc.? So that's Rusha. Yeah. If you think things are going to get worse, then those defensive sectors would be one way to preserve your the value of your equity portfolio, the equity part of your portfolio. Bonds are a much better way to preserve capital. So if you are really worried about things getting worse, equity everywhere will sell off. Some sectors will sell off less, like the defensive ones you list, but the bond equity split will be a much better way of preserving capital than the particular sector composition of your equity, I'd say. But you're right, those are defensives. Flying Scotsman, would you ever invest in something like Fundsmith? Now, personally, I wouldn't, but many of the pension crafters do. And what I would say is that I think Terry Smith is a brilliant fund manager. So he's one of the best, probably, in the UK. And that's why so many people are investing in his fund, because the returns have been very good. What I don't like about Terry Smith's fund is firstly that he's not a young man, and it's a very concentrated fund, and it depends on its manager very much. So for example, if I've got a pension crafter who's 20, Terry Smith's not going to be around in 10, 20 years time, which is only the kind of beginning of their investment career. And his expenses are very high. So the fee for Terry Smith's fund is about 1%. So that presents a very high barrier to beat year after year after year. So in 2019, he didn't do very well. So a lot of these very successful fund managers, for some reason, whatever it is, they lose their mojo. It's happened time and time again. And I get a lot of hate when I talk about Terry Smith, even though I think he's great, really funny, and really knows his stuff, really cares about providing a good return for his clients. But I just don't believe that many of these active managers can consistently outperform year after year for a very long period of time. There are very few Warren Buffetts out there. I think Terry's pretty close, but who knows? He may implode like Bill Miller and so many active managers before him. So personally, no, I wouldn't. Have you reviewed the performance of the scalable capital portfolios? How do they compare to the Vanguard funds? I haven't looked at scalable recently. It would be interesting to see how well they've performed through this crisis, because I don't know if you know how that works, but scalable capital is a volatility managed fund. It comes from this kind of school of thought which says that if you manage risk, return looks after itself. So what they do is they go for low volatility portfolios. Well, they actually have a variety of risk for their different funds, and they reduce the volatility of their funds when volatility picks up. So they move into safer assets when vol picks up across different asset types. So in theory, they should have gone to much safer portfolios recently, but it's not something I've checked recently. It'd be a really good test of whether they've successfully managed to control the risk in their portfolios dynamically. So I don't know is the answer. That might be a good review, actually, down the road. Are gold mines at 10% of the portfolio a good bet right now? Now, the thing is, many people buy gold miners rather than gold because gold miners provide an income because they're shares and they're linked to the price of gold. But during an equity market sell-off, it doesn't matter if you're a gold miner, your equity value will still sell off. So on the upside, at least gold will give you that protection in a crisis, and they are partially linked to the price of gold, but during a crisis they'll sell off a lot. So whereas gold tends to keep its value or rally slightly during a crisis, gold miners probably won't. So that you've got much higher risk with the gold miners. Okay, Buffett and late Jack Bogle expect equity returns over the next decade to average around 5%. Why invest in bonds and reinforce a weak performance for a decade? So this is Dams 66 Black. Yeah, I mean, if you believe those forecasts, then if you actually look at the Vanguard forecasts over the next decade, the equity performance is forecast to be around 45%. The fixed income lower at about 2%. So the reason why you'd invest in fixed income at the moment is capital preservation. So that's why 80% of my portfolio is in government bonds right now, because I think it is going to get worse and I want to preserve my capital. And I think there'll be a better entry point for equity later on. And I'm not convinced that earnings are fully priced in, even forward earnings. I don't think they're fully priced in what's going on. We haven't had long enough to see what the effects will be. So I'm going to wait until we know. Okay, talking about Warren Buffett. What's your view on Vanguard Value Factor Fund? This is Sash Media 1. Well, if you look at the performance of all of the Vanguard Factor funds, value has been hugely out of favour. And in this sell-off, it's been absolutely hammered. So value is a very odd factor in the sense that it outperformed for a very long period of time, decades. And then suddenly, when we had the emergence of growth stocks becoming much more popular, and that typically means tech, then value suddenly became much less popular as a factor, and it remains out of favour. So personally, I had value factor for a while, but now I'm in minimum volatility because of this volatile period. But coming out of a crisis, apparently, if you look at the performance of different factors at each point in the business cycle, there are some research papers which show that value does very well in the recovery phase after a recession. So this could be finally the chance for value to shine. Who knows? But yeah, personally, I don't have value factor in my portfolio anymore. What are your thoughts on funds versus index trackers? I guess you're talking about active versus passive. This is Murray Hart. Well, personally, I pay attention to what the Spiva report says, which is that 80% of active managers underperform their index net of fees. So I'm very wary of fund managers which claim they'll outperform, but which charge a fee whether they perform or not. So one of the fund managers I do like, one of the active ones, is Orbis, because their fees are cut to zero. In fact, they pay you back if they fail to beat the index. And because they've got skin in the game, they will lose in their profits. Their profits will be hit if they don't outperform the index. Whereas you look at another fund manager like Terry Smith or many of the other fund managers, they take their fee whether they outperform or not, which is crazy. I mean, what other industry would you have only a 20% chance of success, but you charge somebody a fee anyway? I mean, you'd never find that in any other industry. If you had a taxi driver that would say, yeah, I'll take you to a destination, Gov, but there's only a 1 in 5 chance we'll get there. Oh, and can I have my fee up front? You'd never pay it, right? But the fund management industry has been getting away with that for decades. I think people are changing that because with the rise of Vanguard, people are seeing that there's a problem. But I think companies like Orbis, where it's performance-related active management, I think that is an interesting model for paying for active management. And if I was going to pay for active, that's probably the way I'd do it. Probably. But I'll probably stick with passive. Let me scroll down here. Give this good man some more thumbs up. Absolutely, Norman Green. I completely agree with that. Let's make this video at least 200 thumbs up. I agree with that, Victoril, as well. This is great and free advice. It's not advice, it's education. Bear in mind. Yes, thank you, Victoril. Not advice. Would you invest in Vanguard 80% life strategy? Not right now, but if equity valuations were more attractive, sure. Yeah, I would. Abdul Rahman Awad says, I don't own stocks. I live in a rental home. All I own is money in the bank. Where is my future going? That's pretty depressing, I've got to say. I mean, if you are young, Abdul Rahman, I would say that you should at least consider equity, because over the long term, it probably will give you returns which are much better than cash. For cash at the moment, you're probably getting a negative real return, a guaranteed negative return, in other words. Dylan Reynolds says, don't forget your power hour. Yes, if you want a one-to-one chat with me, it costs £80 an hour. You can find it on our PensionCraft website. Thank you for that. And like that, you have 200 likes. Thank you, Murray. Thank you for suggesting it. Oh, PV equals nRT, Jonathan King. Ideal gas equation. Thank you for that. You make a physicist's heart proud. Thank you. Sunday evening well spent. Thank you, Johnny Wurzel. Thank you. Thank you so much, Ramin. Absolutely terrific time. Please like the video. Yes. Turkish 10-year yields of 14%. Gosh. Would you consider some gold in your portfolio as an inflation hedge? No. Look at my video on gold and inflation. The two are very poorly linked. What it is good for is as an equity hedge in a crash, but it's not very good as an inflation hedge. The best inflation hedge is inflation-linked bonds of your own country. Brilliant. Okay, so I think we're about there, actually. So just to recap, yes, you can join our community. We have talks like this every Sunday. It's very informal, and it costs just $10 a month to support us. You can join us on Slack, and that's the chat application, and ask questions of each other. It's quite jolly. We ask lots of questions there, very informal. The course has got a 25% discount for Patreon supporters. And the course's name is Investment Navigation Through Crisis. The link is in the description of this video. It will be dynamic. I'll change it as circumstances change. And thank you all for your time. I really appreciate it on a Sunday evening. Oh dear, Saturday evening. Gosh, I'm used to Sunday evenings. Yeah, so thank you all for attending, and take care. Keep well.